fashion here. I'm going to go ahead and get us rolling.
Yeah, go ahead.
All right, well, welcome everybody to the September 2011 edition of the Challenge Club. And again, I see a lot of familiar faces. Welcome back to all of you. I hope your summers have all gone well. We still hope for a few weeks of summer here in southeastern Michigan to wind down a nice autumn as the leaves begin to change. And the Challenge Club has been doing better. We'll take a look at some of the statistics here in a second. And I just want to issue a special welcome to perhaps some of the newcomers that are here. If you are, I see a lot of familiar names, but if you are a newcomer, this is a fairly watered down simulation or emulation of an investment club environment. We'll go over the agenda here in a minute, but again, welcome. If you are here as a first-time visitor or a guest or a fairly recent newcomer, if a motion makes it to the floor to either sell or buy for the model portfolio that we take care of collectively, you are welcome to vote. You're also welcome to share any comments, thoughts, questions, or anything along the way, as we would very much in a typical investment club. So with that, I think we'll go ahead and get started. Is there anything else we got to cover at this point, Lori? Or?
No, I just go ahead and make sure you click on the screen. There's something weird about GoToMeeting that it won't start recording if you don't do that.
Okay. Do you think I got it?
I hope so. I had one come out black and found out that was the problem.
Oh, really? Okay.
Yeah.
We should be in good enough shape. Okay, before we get started, very quickly, in case any of you are a relative newcomer to this, these are educational demonstrations. That's what this investing community is all about. Learning together. Everything we do is for illustration and demonstration of portfolio and analysis concepts, and no investment recommendation is intended. We could talk about real stocks in real time. There could even be stocks that we own. So just be aware of that condition. This is the basic standing agenda that we have for these meetings. We do talk a little bit about the benchmarking and financial status of the club. In a nutshell, the club has performed fairly well going back to its infantile days back in the late 1990s. We've met in a variety of different venues. A couple of years ago, January 2010, we switched to the Vivio club accounting system, so we do keep track of our performance and accounting records there now. So we'll take a quick look at that. We often have a challenge discussion. In most cases, it's the company with the lowest return forecast, according to the dashboard. Tonight, I think we're going to flip it around and focus in on the other end of the dashboard, where we have a couple of inhabiting positions that have some of those nosebleed type returns, and that kind of too good to be true land, or perhaps too good to be true land, and we'll probably take a look at one of those. From there, we simply go into a session where anybody here can nominate a current position for a selling analysis, a selling motion, and we typically like to do that first and kind of do it in a logical sequence, selling those which should be sold, and then moving on to purchasing either existing holdings or holdings from outside the portfolio. A little caveat on that also, we are up to 19 stocks. We don't like to go too much above 20. In fact, we kind of have an informal limit at 20 holdings. That if we attempt to go above 20, it does become a situation where we'd rather see an existing holding replaced within the portfolio rather than to run up the total. If we have any time left over, we will go into open discussion and education, and we never have time for this, but we do have a Challenge Club Select, where the club voted for 5 companies, 5 stocks back on February 2nd, Groundhog Day 2011, and it's participating in that Groundhog Challenge for this year. Just a quick look at the track record, and we'll take a look at the benchmark report in a second. Again, it goes back to 1999. The long-term performance is shown here. That's tracking annualized total return, because we only made the switch to IRR and the Vivio system at the beginning of 2010. But you can see that the long-term performance is approximately 6% versus 1.5%. So it's tracking pretty well in a relative return range of about a positive 4.5%, roughly. Here's the performance over the last We're coming up on 2 years anyhow. We're up to almost 1 and 3/4 years. Um, Within Bivio, you have the opportunity to benchmark against whatever benchmark you want to select. In this case, we've just used the Vanguard 500. You could just as easily use a total stock market index, which is something we would often use also. And it really doesn't matter other than to just be kind of keeping your finger up in the air, seeing which way the wind is blowing. You can see that over that time frame, from January 2010 to now, we have a return that's bumping up against 1% at 0.8. This 0.8% in internal rate of return during a period when the stock market, or at least the S&P 500, has gone up 5.2%. So one minus the other gives us a negative relative return, again, over that 20-month time frame of minus 4.4. That was minus 5.4 a month ago. So it's not the type of thing that we get the heebie-jeebies or have any type of fits or seizures over, but we would like to see that number come back into a healthier condition, and all you can do to achieve that is to continue to pick high quality stocks at attractive prices. That's what we try to do here. With that, let's go into a quick look at the portfolio again in dashboard diagnostic style. Take a look at what we've got. The portfolio is set up right now for a projected annual return par somewhere in the 14 to 15% range, as is shown here. We'd really like to see that with the par tonight. My par is the median projected return for the approximately 2,500, we're actually pushing up on 2,600 stocks that we cover, is 11.5%. So we like to try to stay 5 percentage points above that, and that's what's shown here by the target range. We would really like to see this reading over here at 16.5% or higher, perhaps a little bit higher. The quality rating is fine. The quality rating for the portfolio is 79.5. Can't get a whole lot better than that. Hopefully we didn't just lose Lori. That sounded like a little bit of still there, Lori?
Yeah, I'm here.
Okay, we had a little music going on there.
Music?
Maybe it's like a harp playing in the background. Maybe it's a heavenly situation or something. I don't know.
That's weird.
All right, so the projected return is a little bit light, but we do have a little bit of cash. That'll pull that down a bit. The quality's fine, and the sales growth is actually fine, indicating that we've got a fairly decent mix of small, medium, and large. We'd really like that to be somewhere in the 11%, plus or minus a percent or so. So that's in pretty good shape. Pretty traditional PE ratios. That's the average projected annual PE ratio, projected average PE ratio. 16 to 17 is pretty normal, especially considering some of the higher quality companies that are in the portfolio. Yield of approximately 1%, financial strength rating that would be equivalent to an average A+ rating, if you want to think of it in value line terms. And the EPS stability means that the earnings trends in our visual analyses for all of the companies look pretty much up, straight, and parallel. By the way, I can't do it here because we don't have a camera, but they came up with a brand new cheer for up, straight, and parallel that looks a whole lot like, and forgive me for even bringing this up, but it looks like the thing you do for YMCA where you do the dance and you make the letters. You'll see it sometime. You won't believe it, but I'll just share that for kicks. Up, straight, and parallel. Here's a quick look at the portfolio diversification from a sector standpoint. Again, we want to de-emphasize this, but don't focus on it, don't obsess over it, just be aware of it. And in this case, we see that the portfolio is dominated by healthcare and technology. That's related to the opportunities that have come before us here over the last 2 to 3 years. Pretty healthy dose of staples. I have to say, I wish we could have had a little bit more in discretionary, as hot as that sector has been. We have a tiny bit in financials and telecom and a tiny bit of cash going into it. Nothing too greatly out of line, except that I don't think I'd be in a hurry for this club to pursue healthcare, and for that matter, not even a whole lot more technology unless you had a really good can't miss opportunity. The size diversification, again, we do it a little bit different here. We talk about the size diversification in terms of, we got to see what's going on here, Lori. I don't see where that's coming from. I mean, am I the only one hearing that noise? It would be the question. It sounds almost like a harp playing.
I don't hear anything.
So I guess I'm hearing things now. This is also not a good sign. First we go from you
Everybody
wandering
else
around in
is
the woods.
saying they don't hear anything. We're worried about you, Mark, if you're hearing angels.
It was a long weekend in Cincinnati. I mean, there were a couple late evenings, but I was drinking Diet Coke, folks. So I don't at least have that to blame on. Anyhow, coming back and trying to maintain some semblance of order here. The size diversification looks pretty good. We call any company that's growing at 7% or less large. Anything that is growing at 12% or higher, small. Pretty good mix of the small companies within the portfolio. That explains the 12.3% for the portfolio, and a pretty nice slice of medium companies. So if anything, we want to shopping for or be vigilant for opportunities to perhaps sell off small. Again, you don't have to rush into it, but watch for opportunities to sell off a small company, perhaps replace it with a large, but again, nothing to really obsess over, at least not in my opinion anyhow. Here's a look at the portfolio. I think I captured tonight's closing prices, so if not, it could be off by a tiny amount. These have been sorted using the column on the far right. If you click on any column header at Manifest Investing when you're looking at a portfolio, you sort from ascending to descending. Projected annual return in this case, you can see that the top two on the right are NeutralTandem at 24.4. That's the one I would propose that we audit tonight. We can take a look at anything that the group wants to, but we might audit that and say, do we really believe that 24.4 is reasonable? BioReference Labs is number 2 in place, and it's another one. I have looked around fairly extensively, talked to some shareholders for any more signs of potential shenanigans at the company. I know it's getting beat up by the short sellers in the media, or at least it was there for a while. It's another one that we could talk about. I would argue that Colgate-Palmolive, even at a 6, is still a fairly high-quality core holding. Wouldn't be in a rush to sell it. Depending on the overall portfolio conditions. If the overall portfolio was at 9% and Colgate was at 6, then it would be a sell candidate. But we're close enough to my part plus 5 that I don't think we really have to worry about it. And those other companies at the bottom 2 are pretty high quality. They're nowhere near money market rates, which is where I would generally suggest that we as a group consider selling them. So we really have no direct selling candidates unless somebody out there is aware of a major shift in trend for any of these companies that's really going to dramatically change the situation here. Let's go ahead and we always capture, again, these PowerPoint slides are retained for archival purposes in the Manifest forum in the Challenge Club folder. So this presentation is there, again, just as a matter of record keeping, what is specifically in the portfolio, how much, and on this slide you can actually access the cost basis per share. What I'm going to propose, unless somebody objects to it strongly, is that we begin to take a look at the benefits of any potential tax-related selling, and we might get into some just basically analysis of capital gains and losses next month. I think October is a great time to, well, beginning in September, but getting into October. People used to wait till December to do it, and what we've witnessed here over the last several years is that what used to be known as the January effect, and that has to do with a lot of selling off of especially some of the smaller companies in the final month of the year with repurchasing type atmosphere in January. What we think we see now is that actually begins to take place not only in December, but it's actually drifting back into November and in some cases October. And I think Lori, our accountant, would also agree that with respect to tax planning, both on a club and an individual basis, it's a pretty good idea to start thinking about any potential transactions that might be tax related as early as October. Any thoughts on that, Lori?
Yeah, it doesn't ever hurt to keep an eye on that. It's it's not a one-size-fits-all kind of thing, so it's kind of hard to say, but it's going to depend on your situation and if you've had gains or if you think something's a loss and you want to harvest it and you want to buy the stock back 30 days later, sometimes that's not a bad idea either.
Mm-hmm.
But if you for sure don't really want something, you don't think it's going to go anywhere, I'd take the loss and get rid of it.
I mean, perhaps we could go into what a wash sale is next month, and that sort of thing to be cautionary about when capturing those type of losses.
Yeah, it's pretty simple. You basically can't buy or sell it within 60 days around the date of the sale. Otherwise, you're disallowed. The loss is disallowed, and you get it eventually, but it gets postponed.
Mm-hmm.
So you don't want to sell something and buy it right back before 30 days have gone by. Or if you just bought it like in a dividend reinvestment, you got to be a little careful too. If you just bought something in a dividend reinvestment and then you sell at a loss, you're going to have a problem too, because it's 30 days before and after the date of the loss.
All right, let's go ahead and see if anybody has any comments or questions at this point. I don't show any hands up. I'm still getting a little bit of that sound. I don't know what that is.
Ann says Colgate has gained about 8% since our last meeting.
Yeah. Any other comments? Either raise hands or enter questions in the questions tab. See a few people have chimed in. See what's on Dan Hornick's mind. Dan Hornick has shared the Ticker Talk is also recorded, so that one can also be something you access on your own time in your pajamas with your favorite beverage. Thanks, Dan. Anybody else?
Ann says Colgate has gained about 18% since January.
Yeah, that's all these people are saying they don't hear the noise. It really concerns me. And for those of you that keep score all the time, Colgate is among one of my father's largest holdings, so he's happy he doesn't make me sleep in the driveway, at least not lately. And Dan Hornick says that Apple's doing very nicely compared to Microsoft. I know I hear about it every day from Lori. Dan,